When it comes to your money, it's very important to have the right strategy, a strategy that balances risk versus reward. And that is exactly what we're discussing today with Michael Canet with The Savvy Investor. He's also a popular radio show host and best-selling author. Michael, thanks for being here, sir.
Thank you, White.
Great to have you. And I guess question number one right out of the gate, what is asset allocation and why is it so important?
I think everybody understands conceptually the idea of a diversification, and I think most people have seen those Morningstar style boxes where you put a little bit in each of these categories, and as long as you have a little bit in each, you're considered diversified.
Okay.
And I think that held true for a long time, but clearly over the last decade, since 2008, things have changed. The market moves much more in tandem. When we saw in 2008 everything crashing, diversification didn't work the way it did, and from that perspective, you have to look at things going forward, perhaps a little different than you might have done when your parents were doing this.
Yeah, well, things certainly changed through the years. We know that. We also know this is not a one-size-fits-all approach. What would you say that the key is for setting up different plans for different people?
Well, our perspective is always you should always take the least amount of risk necessary to accomplish your goals.
Okay.
And unfortunately, what most people do frequently is they misunderstand the idea of returns and actual returns versus average returns. And they see all this noise in the media saying invest in the stock market, invest in the stock market. And really what they have to understand is that when you put money in the market, it doesn't necessarily, when you see these averages, they don't necessarily mean that's what you're getting. And you have to understand that. Take the least amount of risk, no matter what you do, to accomplish whatever the financial goal happens to be.
And I know there's different approaches, and this can break down different ways, different sort of strategies involved with that. Talking about changing the way your portfolio is structured, some different approaches there. Talk about those.
Well, for a lot of people, what they look for is, I just want to buy and hold in the stock market. Okay. I'm just going to buy whatever diversification I think I'm supposed to have. And they don't really think about what's going to do well, how they're going to measure what they're doing. And from our perspective, investing in the right categories is important, and you want to be in the right spots, but also protecting your money from the downside, risk management, making sure that when the stock market does turn against you, and if you think about this, we're 8.5 years into a bull market. I mean, that's just non-existent. And at some point, you're going to have a 20 to 40% pullback, and you better be prepared for it because, losing 20 to 40% 2 or 3 years before you retire could be just absolutely horrible.
All right, so let's take a look at this. We've got it up on the screen. Break this down a little bit for us.
Well, I mean, think about this. People assume when you lose 20%, and like it says, when you lose 20%, you lost $20,000, you have $80,000 left over. Well, that makes perfect sense. The problem becomes when you go to invest it back in, that 20% that comes back, you only have 16,000, right? So you're not back to whole. So for the people in 2008, most of those people took 3 to 5 years just to break even because of that 40% drop. Imagine having a different approach towards this so that you have a strategy that says, hey, look, let's not lose that money. Let's not take the risk. Have something defensive in your portfolio. Some people use stop loss orders in the past. We think those are a little bit slippery.
And explain that, stop loss. What are we looking at here?
So traditionally a way a stop loss would work is you'd have an exchange traded fund or a stock, and you would put, you'd buy, let's say you put $100,000 worth of it. You put an order in that says, sell this stock if it goes down 10%. Well, that makes perfect sense.
Sure.
Because in theory, it should stop it at a 10,000 loss. Unfortunately, with flash crashes today, it doesn't. You could lose 30, 40% because it breaks right through. So if you have some sort of stop loss, what happens if you did it on the whole portfolio? What happens if you had software that would put it on the whole portfolio? Then you could catch it at that 10% down. So instead of losing that 20, 30, 40, you might only lose 10. And then at that point, coming back that 20% when the market comes back up, you can see 96,000 versus 108. What's a better deal for you?
I know which one I would rather have in the bank.
Absolutely.
I'll take the 108.
Absolutely.
Michael, thank you so much. If you have questions about your asset allocation or realize you may want to make a change, Michael is here to help. That's why today, for the first 5 callers, he's offering a complimentary retirement review. The number for you to call on your screen there, 866-597-1040. Again, this offer good for the first 5 callers. Coming up next, you're going to want to stay with us. Elsa